Hi, students. I owe you a better explanation of the California Pizza Kitchen case. I'm going to have to move around the screen a little bit to get you more of a high-definition image of this screencast. For starters, this is the exhibit that we showed toward the end of class. It has the pro forma, which means, again, as if this happened, effects of the decisions to borrow 10% of capital or 20% of capital or 30% of capital. The first column here are the actual 2007 expected results. There's some income statement highlights, summaries of earnings before income taxes and interest, the interest expense, earnings before taxes, income taxes, and net income. All of these are going to be affected by the decision to borrow money. Also have the assumption that if they borrowed money at 16, they would pay, based on the bank loan, 6.16%. And there is also this assumption that they're not borrowing enough relative to their capital to cause their interest rate to rise. So we're going to keep that constant throughout the three scenarios for debt to capital. The tax rate's not going to change, seldom changes in these examples. And the earnings before interest and taxes, again, is not going to be affected by the decision to borrow money because it happens to be before interest and taxes. Borrowing money does affect interest and it does affect taxes. We just need to see how much. What we're doing here is with each decision, 10%, 20%, or 30%, this is going to affect the interest expense because the more they borrow, the higher the interest expense they pay. It will affect the earnings before taxes because that's interest expense subtracted from earnings before interest and taxes, and the income taxes they pay because if this number is smaller, the 32.5% is levied against a lower earnings before taxes because the interest is coming out of this number. So income taxes is going to go down too, even though the tax rate stays the same, there is a lower earnings to tax. As a result, net income is going to decline because the earnings before taxes are going to decline, but the after-tax earnings are going to be, because the taxes are lower, they're going to get a little bit of that back in the after-tax, but it's still going to decline. Okay, you can't really make money by paying taxes. It's just how that works. Anyway, what happens to the balance sheet? Well, in the balance sheet, we begin with this $225,888,000 in total capital, which is entirely equity. We saw that from the earlier exhibits. They have no debt. If they are borrowing 10% of capital, then they will be borrowing 10% of $225 million, so that's $22,589,000. Of course, that is how they calculated the interest expense. They looked at the 6.16% of $22,589,000 to get this $1,391,000. Since the debt is not going into the business to increase the assets, it is only being used to repurchase shares to reduce equity, then assets not being changed, debt increasing to $22.6 million, then equity has to go down by the same amount. So the total capital doesn't change. It is just now part debt and part equity. What does that do to return on equity? Well, return on equity is actually going up, and the reason why it's going up is that while equity, while the return, meaning net income, this is just return on equity is net income over total assets, net income has declined, equity has declined as well. And net income has declined at a slower rate, we can say, than the equity has. The equity, so we would get the effect, which is typical of using more leverage, as we described in class with the house example. The lower the base of equity, the higher the return given a change in income. And just to demonstrate, I'm going to use this toggle up here that affects this. You see, I think I've got a pointer that is affecting this earnings before interest and taxes. We're pretending again that this is the operating earnings before all of this other stuff happens. And if the performance isn't as expected, we're using 1 as the base case. But if it were actually a decline, I mean, actually a negative, if they took losses, I put a negative 1 in here, you'll see that it didn't affect, it's only looking at these forecasts. The more debt that they have on the balance sheet, the bigger the swing in return on equity. Again, if you watch this 30% number, it's 11.1 as a result of the using 30% of the capitalization, debt for 30% of the capitalization, and 20% it's 10.2, 9.5 for 10%. But if if they lose money, there's a much more severe swing in this number than there is in this, because there is greater sensitivity on a lower equity base to given the same change. This number doesn't change, but because of the smaller denominator, there's a greater swing. Moving on, of course, we always look at market value because market value is sort of the real thing. And let's remember that market value is forward-looking. It is based on, you can see the calculation here of market value of equity, which is the price per share times the shares outstanding. And the market value of equity at the beginning of this case is $643,773,000. And the price per share is determined by the shareholders who are looking beyond the most recent book value of the company to future earnings or future benefits they get. In so doing, when the company adds debt, there is going to be effect to the market value of equity because, again, the debt they cannot increase market capitalization by adding debt. Actually, they do, because there is the tax shield, the lower taxes, represents a benefit that would otherwise be paid to the IRS if they did not have debt. So the calculation for this is, I have to light this up here or show you the details, is the previous market value of equity plus the interest tax shield, which is simplified as the amount of debt times the taxes paid, D times T, minus the debt. So while equity is reduced by debt because the assets don't change, there is a recovery of sorts from the interest tax shield. That's money that goes back to the shareholders. We don't see it on a book basis because the book is static. It is not looking at the future benefit of the interest tax shield. But the shareholders should, because whatever they estimated the cash flow to be without debt, it is improved slightly. Remember, it is reduced by virtue of the interest expense, but the tax rate the tax benefit flows to the shareholders. The market value of debt to capital, debt is very low relative to capital, remains low, 3%. With the 10% increase in debt, only a 10% with a 30% increase in debt, because the market to book ratio is so much higher for California Pizza Kitchen. Let's see what happens to share price. Well, share price, we look at the given share price in the market at $22.10 a share. With the 10% increase in debt, remember the benefit of the interest tax shield, which again I'll put here. We once again look at the previous share price of $22.10. We add to it the interest tax shield, which is the 32.5% of the debt that they borrowed, and you divide it by number of shares outstanding. The initial number of shares outstanding is 29,130,000. So the price per share is expected to go up with each incremental increase in debt. So if they go to 30% debt, they should, because of, again, what they're not giving to the IRS, see their stock price go to $22.86. All things being, not given any shocks, just based on the intrinsic value of the business. Now they are also repurchasing shares with the cash, so they're taking shares off the market. So the 1,011,000 that you see here is what, at $22.35 a share, what 22,589,000. How many shares will they buy? So they take this cash that they borrowed and they use it to buy shares, and that will buy them 1,011,000, and that will reduce the shares outstanding. You subtract this number here from the previous number by that. What does it do to earnings per share? Well, even though shares decline in number, remember earnings as well declined because of the interest expense that they incurred. So interest did not stay constant, so there's a slight decline in earnings per share across here. The price to earnings ratio, however, goes up because the share price goes up at a faster rate than the earnings per share goes down. Now, this is a bit confusing in all these directions, but you can see the effect. Again, best way to do is to set up the spreadsheet, and the calculations I'm showing all on the right column. What happens to beta? Now, beta is the interesting one. The beta starts out at 0.85. It's measured, but remember, the beta is the variability of the value of the business given changes in the market, in the market index. We would expect that the equity, since it's equity beta, if the equity is lower because of debt, a change in the, as we saw, a change in earnings would create greater variability in debt. We saw that again, remember, when we were toggling that 1 to -1, so there's the more debt, the greater risk. And the way this is calculated, we saw this again in the Boeing case, is this formula here, where we take the unlevered beta the levered beta is equal to the unlevered beta times 1 minus the tax rate times the debt to equity ratio. So what we're doing here is using this longer one. We take the previous beta, take 1 plus 1 minus the tax number, which is way up here, the 32.5%, times debt divided by equity. So this, if we had no taxes, then the effect would be the full leverage on beta. But the tax rate, 1 minus the tax rate, reduces it proportionally, reduces that effect, because again, that improves the flow to the shareholders. You could see what happens to